Rajiv. I'm a managing partner at RIAs Venture Partners. We are an early stage fund deployed in 95 startups. India is on a roll digitally, and hence we have 3 unicorns now and growing on a regular basis. So that's a little bit about us. I welcome all of you. I'm very excited to be doing this session with Michael. Michael is the portfolio manager at Toroso Investments, and an investment management company with a portfolio of $7.5 billion of assets under management. Toroso has got blockchain ETFs, risk parity ETFs, et cetera, et cetera. They do a lot of non-traditional strategies. And of course, Michael is a proponent of the risk on, risk off, or what he calls RORO strategy, and a publisher of the famous Lead Lag report, and a co-author of 4 award-winning research papers on market anomalies in investing. Michael is an active contributor to MarketWatch and has been interviewed on CNBC, Bloomberg, and Fox Business, as well as on the Wall Street Journal. He's an out-of-the-box thinker and has a proven track record of investing, quickly understanding market dynamics and relationships that few tend to focus on. His lumber to gold ratio is oft quoted and discussed in investment circles, and it has won a lot of awards as well. Michael started early as an investment guru, following his father, whose name was also Michael Guyett. He has actually written a foreword to his father's book, Intermarket Analysis and Investing, which dives into the correlations between asset classes. In our venture capital world, Michael, we love serial entrepreneurs, so we look forward to today's conversation particularly. He's an NYU Stern alum and a CFA charter holder. He's also a 2-time winner of the Charles H. Dow Award for 2014 and 2016. So today I'm going to do this slightly differently. I'm going to start off with a series of questions for him. And Michael is a fantastic storyteller, so all I need to do is to just sort of light the match and I just step away. And once we have established 30-40 minutes in his thesis and strategy, we'll get into the Q&A. Please do add to the list of questions on your chat box, so we'll get to them after we've sort of established the thesis. So Michael, anything to add before I start to jump into the questions?
No, I feel you're making me blush again.
All right, hopefully, we'll have more causes to blush in the next, 1 hour or so. So let us start off with the risk on, risk off strategy. You mentioned frequently that one has to really manage risk and not return. I like the way you put it. The idea is not to kill it, but to not get killed, right? I think it's an amazing point of view. And that's the basis for your risk on, risk off approach. Please talk to us about it. Can you sort of help us understand and explain the underpinnings of that strategy?
Yeah, so I think it's important first to define what I mean by risk on, risk off, because certainly in the US, the media often references these terms. Really, they started saying this starting in 2008 with the financial crisis. But first, we have to define what risk on, risk off is and what killing it in the stock market is, right? So to me, risk on, risk off is not about direction in the stock market or in risk assets. To me, it's much more about conditions that favor an accident, right, in equity markets. And when I say accident, really what I'm referring to are the black swans, the fat tail, the big kind of extreme movements that tend to occur in stocks periodically, which should theoretically be 1 in 1,000-year events, but end up happening much more frequently than once in 1,000 years. And if you have the mindset that risk on, risk off is about conditions as opposed to trend, it opens you up to a whole different way about thinking about how you invest and how you put your own money at risk. Now, for me, the risk off side is the most important part of the investment equation. Some people think it's a little strange because a lot would argue that markets tend to go up over the long term, so buy and hold, who cares about the downside? And I don't necessarily disagree, but the reality is that human behavior counters that notion, right? The joke about buy and hold in any investment in any part of the world, whether it's India markets or US markets or anything else, the joke about buy and hold is that very few people actually hold. So you have to be aware of the sequence of returns and the risk that might occur in markets, not necessarily just in terms of a portfolio going through a drawdown, but also in terms of your reaction to that drawdown, meaning selling out at the exact wrong time, which is a very kind of classic investor behavior. Now, this idea of to kill it in the stock market, you have to not get killed. We know the math of this, right? If you're down 50%, you have to double to break even. The downside mathematically matters a lot more than the upside. The problem, of course, is that most people want to chase on the upside. They want to speed up. They don't want to necessarily slow down. And yet I would argue that slowing down is the only way you actually outperform. So it's not really about taking on more risk to get more return. It's about taking on less risk at the right time. Because if you can minimize those declines, those drawdowns, you can significantly generate wealth over a longer term time period. The problem, of course, is determining when those periods are, which we'll get into. But I would encourage everybody that's listening to this to try to keep an open mind that when you're thinking about most investments, at least in the public markets, what matters is not being up more. What matters is being down less, and that there are these identifiable ways of telling the weather that suggest now is the time to slow down.
Great. So let's just talk a little bit about that in terms of being down less, right? So I think one of the things that I think you speak about is the role volatility plays in this, right? High volatility versus low volatility in asset classes and in periods in that asset class. Can you talk a little bit more about volatility as a story and how this plays into this thesis?
Yeah, it's interesting, right? Because in the VC and private equity world, volatility is an afterthought because you don't see prices day to day, right? So there's a frequency.
Michael, we are not able to hear you. Sorry.
Can anybody else hear me?
You're back. You're back.
Okay, sorry, I'm not sure what happened there. No, so what I was saying, I apologize. So what I was saying is, it's because of all the construction on my virtual background here. So volatility. Okay. What I was saying was that volatility often doesn't matter, obviously, for venture capital or private equity because you don't see the prices being updated day to day. But that's not to say that the underlying investments aren't volatile. It's just not mark to market, right? So when things are mark to market, volatility matters. Now, volatility is often seen in the traditional finance case as risk. Right, you often hear that risk is tied to volatility, standard deviation. To me, volatility is not about risk. To me, volatility is more about doubt. Right, doubt about what prices should be based on its particular outlook. Now, doubt is healthy. Right, you want to see doubt in an investment because it's hard to really generate outperformance unless other people doubt the investment case. Right, so it's not something to fear; it's just something to recognize. Now, because volatility is doubt, and it's not necessarily about fear, at least in the way that I view it, you can always tell when volatility is likely to increase. Volatility is likely to increase when there is no doubt. When there's tremendous conviction in a particular investment, in a particular idea, that's typically when the market reminds investors that the future is unknowable. The future always has doubt. So volatility has these mean reverting components to it, meaning you have these junctures of extraordinary low volatility, extraordinary certainty, very little doubt, to then the realization that the future is unknowable, to then higher doubt, to then extreme doubt, because it's never as bad as it seems at the extremes, to then going back to complacency, conviction, low volatility. And that's exploitable. Like you can actually try to take advantage of that if you have the right type of rules-based approach. And if you have that mindset, again, my point is that volatility is often where you get the most opportunity, right? So, you can either prepare for volatility to increase and then have enough dry powder to deploy capital when volatility is at its highest, okay? Or you can be pedal to the metal and then go through these periodic momentum crashes, in which case you might sell out of the exact wrong time and miss the rebound. Right? Which all goes back to buy and hold and sort of the joke about buy and hold that nobody holds. So in my world, from the standpoint of how I look at markets in the funds that I run, everything to me is about conditions that favor volatility.
Got it. Got it. So, I think that sort of sets up the next question perfectly. So, I think I remember you're talking about the the weather conditions and the predictability of an accident or a crash, and you're basically watching for. I think your point was the market crawls up and then it falls off a cliff when it's coming down. Can you sort of help us understand how to read these signals going into risk on or risk off, and and the correlations and the probability functions, a little bit of the underlying metrics there?
Yeah, and it's interesting because I always use that analogy of driving because I feel like that's always kind of an appropriate way to think about this. And it's funny because I used to travel all the time, and I know you travel quite a bit too. And when you put an address in your phone GPS to get to your destination, you ever notice that no matter how fast you go, even if you're going above the speed limit, the ETA never really changes. It doesn't have much variability, no matter how fast you're driving, even if you're going above the speed limit. What's the biggest driver of variability in your ETA? It's not how fast you go, it's how slow you go, meaning it's the traffic, right? It's funny because we live this day to day in terms of how to think about risk on, risk off outside of markets. But of course, when people see a chart, it's very different. And my point there is that, again, you have to kind of think differently. And in many ways, risk on, risk off because of false signals means you have to lag to lead, which we'll also talk about. So let's get into, and I'll show my screen just for the sake of kind of just switching up a little bit. So, all this sounds great, but what does it mean in practice? How do you think about this stuff, and how does it apply to India markets and other markets? So just by wasting some background, so you mentioned 4 papers. There's a 5th paper that I won an award on in 2020 because I was bored with COVID. So this is on SSRN, Social Science Research Network. You will see that my face looks a little different on SSRN. I've got lumber and gold eyes, which we'll talk about to kind of make fun a little bit of the laser eyes community that you see when it comes to Bitcoin and cryptocurrencies. But basically, since 2014, I've put out 5 different research studies that have won these different awards. 2 from the Chartered Market Technicians Association, 3 from the National Association of Active Investment Managers. And again, all of these papers, with the exception of the most recent one, I've presented on all over the US. So I've been to 47 states, presenting at CFA chapters, CMT chapters, all over the place. And again, the common thread across all the research is the philosophy, the idea that I may not know the exact mile marker, the exact kilometer, I might crash my car, but I know the conditions that favor an accident. So all of these research studies, in some way, shape, or form, are trying to get to the answer to the question of, is volatility likely to rise or fall going forward? Do the conditions favor the accident? Is it raining? Is it sunny? Okay, and then determining how to allocate based on that. Now, all of the 3 primary papers that I'm known for, which is the study on utilities against the market, the study on treasuries, and the study on lumber relative to gold, all of them tend to warn of a risk-off accident, major bear market crash or correction prior to those events happening. And the reason why they are all anticipatory of the conditions that favor a risk-off period is because whether it's utilities, treasuries, or lumber to gold, all of those are interest rate sensitive relationships. So here in the US, utilities are considered, of all stock market sectors, the most bond-like sector of the stock market, meaning that utilities tend to have bond-like characteristics because electricity companies have high debt, high leverage. They cannot increase the cost of the electricity that they're charging the end consumer because politicians won't have it, okay? And they have to maintain the grid. So their earnings are much more driven by the variability of the cost of capital as opposed to demand fluctuations, okay? And and they have quite a large yield. So typically utilities tend to benefit when rates fall, and they're more seen as a defensive allocation. Historically, utilities outperform the market in shorter time periods in advance of major crashes, corrections, and bear markets. Same dynamic with treasuries. Historically, when you have very long duration treasuries outperforming intermediate, a form of yield curve flattening, rates falling, same idea, you tend to see stock market volatility rising afterwards. And in the case of lumber relative to gold, of all the papers, that one's always the one that gets the most curiosity. Lumber relative to gold is a tell on risk because of the link to housing. So in the US, we know that housing is a leading indicator of the economy. Most people's wealth is in their homes. The average home in the US has about 16,000 board feet of lumber. So it stands to reason that if housing is a leading indicator, well, then lumber by extension must be as well. And if it's tied to housing, it's also tied to mortgage rates. Now, what about gold? Now, I know gold is seen, in different regards in different countries. Certainly in India, gold is a major commodity, and way of sort of investing or keeping some of your assets in place. Gold is more of a safe haven commodity, meaning that historically, when you have high volatility in the stock market, gold tends to do fairly well. So when you compare lumber to gold, same exact story. You tend to see stock market volatility rise afterwards. Risk off periods. A good sort of visualization of that is this slide. So if over the last rolling 13 weeks, lumber's outperforming gold, risk on, the S&P 500's volatility on average is around 12.5%. Doubt is low. If, however, gold is outperforming lumber over the last rolling 13 weeks, as has been the case recently, the S&P's volatility rises quite a bit to an average of 17%. Doubt rises. And that matters because it's in those higher volatility states when you tend to have the accidents. The major crashes, corrections, bear markets tend to occur when you're already moving around violently in equities. Now, I'm obviously talking from a US-centric standpoint here, but keep in mind, everything co-moves in the extremes. Meaning, I don't care if you're sitting in Australia, I don't care if you're sitting in Canada, I don't care if you're sitting in India, wherever you are in the world, if you have an extreme decline, if you have a tail event, if you have markets in the US go down heavy, if lumber to gold, utilities, treasuries do get ahead of those major moves, well, we know that the 1987 crash was not just a US-based phenomenon. We know the COVID crash was not just a US-based phenomenon. Everything co-moves in the extreme. So my point in saying this is that while, again, I'm talking about risk on, risk off in the lead lag report, on my Twitter account at lead lag report, and all these different places, I talk about risk on, risk off from a US standpoint. Anybody overseas watching markets should be aware of this, because if the US sneezes, everyone else gets sick.
Well, in this case, it's true of China too, because they sneezed and the world got COVID. But I get your point. Absolutely. So this is fascinating, right, Michael? So what I want to, if I were to rephrase what I'm hearing you, right? So basically, when the lumber to gold ratio rises, in other words, lumber rises vis-a-vis gold, that means it's risk on. It's risk off. That means basically pile on, press the accelerator, do everything you can, get out of cash.
Right.
Yeah. And then when, that the reverse happens, then you sort of, put the brakes on, get your leg off the accelerator, do the reverse, right? So what does this pylon mean and what does do the reverse mean? What exactly do you do physically with your asset portfolio when you are in a risk on or a risk off mode?
Okay. So this is actually a very important discussion, right? Because again, I'm talking from the standpoint of public markets, right? Every strategy is a function of three things. One is the signal, in this case, utilities or treasuries or lumber to gold or something else, right, that historically has predictive power of volatility. Two is the look back period, meaning, okay, so you may follow a moving average, but is it the 200 moving average, the 50, the 53 moving day average, right? So the look back period with which you're executing also matters. And of course, can be conflicting, meaning you could have stocks above their 200-day moving average, but also below their 50-day. Like it's kind of starting to happen now. And then, of course, the third part of every strategy, which may be just as important, is the opportunity set. How do you execute on that? Okay. When thinking about opportunity sets, ideally, you want to have an opportunity set that allows you to be wrong in your signal, but still make money. So what do I mean by that? Okay. So historically, and I can go through these examples, when lumber is weak relative to gold, you tend to have a high probability risk off scenario going forward. Most major crashes, corrections, and bear markets are preceded by weakness in lumber relative to gold, just like they're preceded by strength in utilities, strength in treasuries. So I can show you a series of examples real quick just to prove that out. So if you look at 1987, this top chart in yellow is the ratio of lumber to gold. Falling ratio means gold is outperforming lumber. Rising ratio means the opposite. Below that is the 13-week rate of change on the ratio. If you cross the zero line, that's risk off. Below, above, risk on. Blue is the S&P equity market. And then red is volatility, VXO, VIX like level index. Prior to the 87 crash, lumber to gold warned in advance of risk off. Prior to the 1990 housing recession, makes sense. It's housing. This is about lumber, which goes into housing. Lumber to gold warned. S&P corrected, and bear market occurred afterwards. Prior to the three major VIX spikes during the tech wreck, 2000, 2001, 2002, lumber to gold warned in advance, risk off prior to those periods. 2008, before Lehman Brothers, same deal. You can see those vertical lines are where the crossover for risk off occurs. Again, you can see same story, exact same series of charts, exact same look back period, exact same signal, risk off beforehand. 2011, okay, summer crash, U.S. credit debt downgrade, which we'll talk about because it may be happening this year. Same deal. Prior to that, Eurozone crisis, warned in advance. 2018, fourth quarter, lumber to gold warned in advance. And then, of course, right before COVID, lumber to gold also warned in advance. Now, people seeing this will say, well, this is great. I should short every time lumber to gold is weak. I should make a directional bet that the market goes down. No. Why? Because every outcome has false positives, meaning there are plenty of times where gold outperforms lumber. You're in a risk-off environment based on those indicators, and the market never goes down. The market keeps going up. If you're short and your signal is wrong, you lose money, 1-for-1. That's like predicting the mile marker, the kilometer, you're going to crash your car, the exact moment it's going to happen. If you're in cash, it also doesn't work, because if you're wrong, you don't have a chance at momentum. You cannot compound if your expression of risk off is cash. However, if you're in lower beta, lower cyclically sensitive sectors of the stock market, whether it's US markets or India markets, you're still going to participate in a false signal, meaning you're still equity, so you still go up if the signal is wrong. And of course, when you go down, hopefully you're down less, which still matters. Or your risk off, which is traditionally more, the sort of more consistent way of playing it is to be in government debt and treasuries, at least in the US. And I think that dynamic probably persists globally, but much more so with US bonds. So I'm saying all this because it's a nuance, right? You have a series of false signals that can happen, which makes it challenging to keep up with the market, because if you're going to keep playing defense, if you're going to keep slowing down, entering the storm, you're naturally going to get to your destination later. And with hindsight, maybe you should have never slowed down entering the storm. So you can be wrong 9 out of 10 times, slowing down, entering the storm, lagging on the upside in markets, lagging in terms of when you get to your destination with the ETA. But the one time it's a true positive, the one time the crash happens, it saves your life. So I always go back to this point that, you know, the research service I put out, which is the lead lag report, you know, that wording is very purposeful, because the only way you lead is to lag. You have to lag on the upside with your opportunity set, expressing risk off with false signals along the way, to lead on the downside to kill it by not getting killed, right? And it's a very nuanced discussion. I can show you a lot of other examples of that. You know, there's these stats called up capture, down capture, right? So it's what percentage does what percentage of the upside of your benchmark is your strategy capturing when the benchmark is positive versus when it's negative. It's okay if you only capture, let's say, 60 to 70% of the upside of your benchmark. It's okay to lag, even though it feels painful, as long as your down capture is, you know, flat or negative, or 10 or 20%. As long as your down capture is less than your up capture, that's all you really care about for longer term wealth generation. But again, you know, few really understand that, and because FOMO is real, fear of missing out is a very real phenomenon. But it's also what gets most people in trouble over long periods of time.
So great. I think, 2 points on this graph itself, but if I understand what you're saying, right. So essentially you're saying don't wait for the very peak for you to exit, or don't even be, worried about the fact that you didn't exit at the very peak or you exited earlier, because it's much more important for you to make sure that you miss the cliffs rather than to hit the peak. I think that's essentially what I think I'm hearing you say. Now, if I look at the lumber gold ratio, I mean, one of the important metrics of something that predicts something is that it has to be a lead indicator. In other words, the actual event should come after it, right? So, but when I look at the graphs, maybe it's a time series. It sort of looks like they're all correlated. When the lumber to gold is falling, the main markets are falling as well. So, how much of this is a lead indicator versus something that falls in parallel, right? In other words, like when I look at gold right now, am I looking at gold and am I looking at the 10-year yield at the same time and sort of investing in that, or how do I play this? How much of a lead time period do I get in this game? I mean, assuming that the actual event, it's not a false positive.
Right. No. So this is a good question. So the truth is nobody really knows how long it would be, right? Just like you can only see up until your horizon, the storm. You don't know how deep the storm goes until some time has passed. Typically, though, if it's a true signal, it's within like 2 to 4 weeks. Why is that? Because markets are largely efficient longer term, right? In other words, the more that some data point is out there, the more likely the likelihood is higher that the market's already anticipated that or priced it in somehow. So usually it's within 2 to 4 weeks. Lehman was within a couple of weeks before it happened. In the case of 2018, it was a full 5 months before you had that very aggressive sell-off, what they called the Christmas Eve massacre, where prior to Christmas, U.S. markets collapsed. Again, I go back to there's no way to know, which is why you have to keep on following every single signal in the same way, right? Because you don't know, except with hindsight, if it's a true positive, and even if it's a true positive, you don't know how long it's going to take for it to actually manifest, right? Which is why I go back to the best way to express risk off is simply to go lower beta, de-risk, not to make a directional bet, and then diversify into risk off assets. Treasuries, again, historically tend to be the best of those. The dollar tends to also be pretty good. And gold also would fit within that risk off category. But it's funny because everybody always wants to find sort of the holy grail signal, and they want to know the exact moment something's going to happen. You don't drive that way. How can you expect that in markets? It's an impossibility.
Great. I think, it's a good cue for me to switch to the next part, really. And that has to do with the statement you made: when the US sneezes, the world catches a cold, right? Now, what is happening behind the scenes is when the Fed sneezes, the US catches a cold, right? So there is almost a direct correlation between what the Fed is doing to the markets and what is happening to the US market, and hence what is happening to the rest of the world market. So, I mean, post-COVID, obviously, the Fed story has become so much all powerful right now. FOMC meeting was a sneeze, and look at what happened to the commodity markets. So, as it were, can you help us understand what changed post-COVID, maybe with the Fed, maybe with other things in the market? What has actually changed in the market itself in terms of the dynamics?
So a couple of things. First of all, it's important to note that the Fed is always intervening. I mean, the Fed was created to intervene, right? It was in response to the banking panic in the early decade, I think it was 1907, the banking crisis of 1907. I think the Fed charter was 1913. Don't quote me on that. So, but I'm pretty sure that's right. So the Fed is always in there. It's always a question of the extent to which the Fed's in there. Now, we know the Fed basically took on, they probably called Mario Draghi and said, what do we do in the midst of COVID? And Draghi said, whatever it takes. Right. So COVID happens, they come in and they basically set a whole new dangerous precedent, which is not just that they are going to support treasuries and they're going to keep rates low, but they're going to actually buy risk assets. So they started taking the playbook from Japan and Bank of Israel and a lot of other central banks that have actually directly intervened in risk assets outside of the normal functioning of monetary policy. Now, here's what's interesting to me about the Fed and kind of where we are in terms of monetary policy, not just in the US, but globally. It's not really working. Why am I saying that? So again, I'll share my screen just to give you a little context. So I try to always look at things in a different kind of way, right? Because I think in today's world, unfortunately, people go into these echo chambers, not thinking differently. And I think that's where you get into trouble. So share my screen again here. Okay, so consider the following. What was the narrative entering this year in the US and I think globally? Narrative is one thing and one thing only. We're re-entering a boom period, not just because of the vaccine and everything, but the reopening, the tremendous monetary stimulus, all of this pent-up demand, all this is going to create this massive boom in global markets. And all the data has been strong economically, at least short term. for the most part. But despite trillions of dollars of stimulus, emerging markets, using the MSCI emerging markets ETF as a proxy, they've gone nowhere since February, despite trillions of dollars of stimulus. Despite trillions of dollars of stimulus, Russell 2000 small caps, okay, which are a proxy for smaller capitalization companies in the US, the vast majority of stocks, which are smaller relative to the large ones everyone hears about, like Facebook, Google, so on and so forth. Small caps have gone nowhere since February, despite trillions of dollars of stimulus. Despite trillions of dollars of stimulus, despite all the Fed's action, despite all the fiscal side as well, lumber has crashed. Now, it's crashed obviously off of a very accentuated advance to begin with, but still. And as you noted, commodities have sold off since the Fed's meetings. And we know Bitcoin crashed, okay? Which, remember, one of the key arguments for Bitcoin and cryptocurrencies is, they're going to keep diluting currency, and the dollars they're going to keep printing. So go into that which has a finite supply. Okay? I don't think, by the way, this decline is over. I could be wrong. And against all that backdrop, despite all of these dollars being printed, guess what? The dollar bottomed. If you look at the dollar UUP, this is actually rising, meaning the dollar is actually appreciating, despite all this narrative about inflation. So this is kind of curious to me because everyone holds the Federal Reserve and all these central banks in such high esteem, but they've also created so much debt that they're kind of their own worst enemy, because the more debt there is in the system, the more the deflationary pressure increases, because you can't really raise rates if your interest expense is more than your payment of the debt, right? So I think we're kind of in this very strange environment where the narrative is actually disconnected from the reality of markets as a discounting mechanism due to Federal Reserve policy, which I would argue now is at a point where it's clear it's not going to be enough. And the more trillions of dollars that are thrown at any problem, the more quadrillions have to be thrown in later. And that's a real problem, because if the efficiency of every new dollar that's printed is less and less over time, well, now you can't really respond to shocks which only get bigger and bigger.
Great question. And I think that leads to Umang's question here. So lumber has, obviously, you mentioned this, lumber has been crashing off late. And, according to the, the lumber gold ratio, gold has been rising as well. So obviously, we are sort of heading, it looks like, head fast into an equity market correction. Is that likely to happen?
I'll tell you after it happens. Right? But I say that jokingly, but it's like I always say, it's like, because there's no way to know, right? I go back to, I do believe we're living in the eye of the storm, meaning that, if things look okay, but a lot of other areas are suggesting that we're not. And then if I'm right that you're in the eye of the storm, the odds are higher of, a tail event wagging, an extreme decline that would happen globally. It doesn't have to be like last year, but even a normal 10, 15, 20% type of decline, I don't think is out of the question by any means. But again, you only know that with hindsight, right? The thing are, not the multiple roles, which is
Michael, I think we lost you for about 20 seconds there. So if you could just,
Yeah, sorry. So hopefully that was. I apologize again for. Can you hear me now?
Yeah, loud and clear.
All right. So what I'm saying is that the reality is that we only live in the single roll of the die. We live in the small sample, whereas markets tend to live in the world of large data, long cycles. And because we live in the small sample, you have to be very careful in terms of thinking that this is it, this is the one, this is it, because you may be correct in your decision based on probabilities, but it's like even when people say, oh, the odds of somebody winning the presidency are 20%. Well, that's not zero, right? But in the small sample, that can be 100% after the fact, right? On the single roll of the die, the 20 becomes 100 because it occurred, right? So it is very possible that we are in a risk-off period. Certainly, bonds seem to be suggesting that. And this actually, if you really want to kind of present a real doomsday scenario, again, I go back to, despite all these trillions of dollars of stimulus, that doesn't seem to be enough to break bonds, to cause lasting inflation, with the behavior of treasury yields having dropped since the middle of March. But you don't know. right? Nobody does. So again, what do you do in response to that? You de-risk, you diversify more into non-correlated portions of a portfolio, and you wait and see and only know with hindsight if it's a real accident or not. All I know is that I think it is raining and it's time to slow down.
I think that's a great point. So, in terms of asset classes, right? If we are, it seems like we are in a risk-off period right now, or at least we are entering into a risk-off period right now. What does that mean in terms of your holding of the multiple asset classes? Is there a viewpoint that you have on, do you hold more bonds, for instance? Do you hold, more precious metals? How does the storyline work?
So I think that this is related to that. It's a discussion around diversification, right? So first of all, let's be clear: diversification is not is not. Richie, can you hear me?
Yeah, we just lost you for another 20 seconds there, Michael.
Yeah. So it's okay. So let's talk about that question in the context of diversification, right? So diversification is not 5 stocks. Diversification is not 500 stocks. Diversification in its purest form means exposure to multiple unknowable futures. Exposure to multiple unknowable futures. Okay. When do you want as much exposure to as many multiple future scenarios as possible? When volatility is low, when doubt is low, when conviction about the future is high, right? Because if everyone is convinced of the unknowable future, there's always opportunity elsewhere. So that's why you want as much diversification, meaning non-correlated assets, towards the tail end of a bull market where everyone is optimistic and everyone's bullish, everyone's overly allocated towards equities. And you want very little exposure to diversification towards the tail end of a bear market, meaning you want more correlation at the end of a decline. You want less correlation towards a prolonged advance. So now the tricky part with that is that there aren't that many true diversifiers. And this is really, really important. And from my viewpoint, there's really only 2 asset classes: those that benefit from low volatility, risk on; those that benefit from high volatility, risk off. The world moves on risk on assets. Progress happens from risk on assets, right? From productivity, from growth, from inflation, all this stuff. So you don't have that many real risk off assets. Again, historically, it tends to be treasuries, gold, and the dollar. The yen used to be among that until Abenomics really came into play. But because of that, you have to sort of say to yourself, okay, well, if you're worried about equities, if you're worried about the state of markets and beta risk, you probably want to allocate more towards gold. You want to allocate more towards strategies, maybe like what I do with the RORO ETF. You want to allocate more towards government debt for a moment in time, because historically that's really the only opportunity set that you have to play with, right? And that's not a popular opinion because nobody, at least in the States, likes treasuries. And a lot of people in the States, they don't like gold either, right? But I would argue to you that that's the only way you can really diversify your portfolio properly. Otherwise, you're just taking on some degree of concentration risk, right? So if you're in a risk-off period, you want to diversify more, again, not based on the number of positions you have, but based on correlations. And gold, the dollar, treasuries tend to be your best ways of doing that.
Great. Let's move on to the crypto. I think you briefly mentioned that, and you spoke about how it was still correcting. I saw a 2.7% or something decline in the crypto thing in your chart. So there are multiple takes on crypto. One is really that it's there is this undercurrent, it seems to be in the US, where there's a group of people that are basically saying we want to break the system, we want to move out of the system, and the system is breaking, so we want to sort of make sure that we are not there when Armageddon happens, and crypto is basically a way to escape the system, whatever it was. So that's one route, that seems to be sort of, there. There is also another route that's sort of saying, what you mentioned, basically it's that, 21 million, you can't go more than that. And, it's already, limited. So scarce asset, more people want it. So obviously it's something that is going to be a store of value like gold. So, continue to do that, right? And then there is this Gen Z, viewpoint, basically, thanks to passive investing or whatever else, every asset class has just been shooting up. So we just don't have an opportunity to buy anything anymore. So Saudi or you oldies will just break everything up and then just get into the crypto ecosystem. And that's another viewpoint that seems to be out there, the Reddit forums and all these things. What actually is happening in crypto in your point of view, and how do you sort of categorize that as an asset class given your risk on risk off strategy?
So I don't view Bitcoin or cryptocurrencies as anything more just than really a levered beta play. And I think people make up stories about the behavior of cryptocurrencies when in reality, all you have to do is look at history to see how it tends to behave. So outright, I'll say I'm not against Bitcoin. I'm not against cryptocurrencies by any means. And I would even argue to you that if you're actively allocating and investing, you don't need to know. Because the only thing you really need to know about is human behavior in any investment. Human behavior, I don't care how good the technology is, human behavior is human behavior, period. Right? Now, the issue that I see with the space, right, is I think there's a lot of overconfidence, to your point, and a lot of sentiment around we need to break the system and the system is unfair because the wealth gap is so wide. I don't disagree, by the way, about that notion. I'm not sure it's because of fiat as opposed to politicians, which are not enforcing the necessary discipline when things are good to pull back on fiat dollars. Right? It's like Greenspan many, many years ago was interviewed, the former Federal Reserve chair, and he was asked a question by the anchor saying, well, what do you think about the interaction of politics and the Federal Reserve? And he said, in all his years as the Fed chair, he never once had any politician send him a letter, not an email, a letter back then, saying to raise rates. Everybody always wants cheap money, right? And politicians get voted in based on promising more, right? Well, to promise more, you need financing to be cheap, right? So there's this incentive mechanism that breaks the fiat story and that makes the wealth gap wider and wider, even though objectively the baseline for the vast majority of the world is higher. I mean, objectively wealth is higher for the bottom tier now than it was 10, 15, 20 years ago. So the wealth gap may have gotten wider, but the bottom is higher than it was before, right, on that range. So I don't believe Bitcoin solves that, okay, because human behavior is human behavior, right? Does it have a role in a portfolio? Yes. Somewhere in that maybe 1 to 5% with rebalancing. There's a lot of evidence that shows that rebalancing back to a target allocation with cryptocurrencies does really, really well. It does historically add alpha. Who knows about the future? Okay. But I don't know why the discussion around cryptocurrencies has to be an all-in discussion. Now, the other part of this is going back to risk on, risk off. Okay. Risk on, risk off is just another way of saying inflation or deflation. That's all it is. Right? Risk on is reflationary hope. Risk assets benefit, they go up. Risk off is deflationary reality. Risk assets go down, volatility increases, liquidity dries up. Okay, well, within that context, if the argument is that the world is going to be eaten by Bitcoin, which maybe it is, maybe it's not, it kind of assumes that the Federal Reserve is going to be effective at devaluing the dollar even further. I just showed you a series of charts showing you that despite trillions of dollars of stimulus, the market doesn't believe it. Every single dollar has less efficiency. I mean, if the argument is that Bitcoin and cryptocurrencies are your hedge against devaluation of currency, we just saw a massive crash. Right now, it's happened many times with Bitcoin, and it's not a critique on Bitcoin that you've had that kind of decline. Why do big declines happen? They tend to happen because of overconfidence. What is the link of big declines to overconfidence? It's over leverage. It's too much conviction. It's low volatility in the investment that you're in, which creates a buildup of hidden risks. For those that are familiar with Nassim Taleb of the Black Swan, this is very classic, right? So, and it's interesting also too, just kind of structurally about cryptocurrencies, I think. At least when you're dealing with local equity markets, there's regulation. Right, you can only leverage so much for the most part in U.S. equities and things like that. But if I were to Google lever up Bitcoin 50x, lever up Dogecoin 100x, you'll see a lot of places in China and other parts of the world that will give you that kind of leverage. That's how you get these big declines. Now, you can unequivocally have Bitcoin and cryptocurrencies keep making money. And I unequivocally see the value in it, especially for emerging economies where they're unbanked, where people need to be able to transact and they can't do so because there's no infrastructure. So they do it through various microfinancing techniques. And cryptocurrencies are a part of that, I think, community. But you got to be careful not being too convinced of this idea that it's a store of value, because volatility says otherwise. Okay? And that's a whole different discussion. You also got to be very careful of your reasons. I know I use the term scarce. I know a lot of people call cryptocurrencies and Bitcoin scarce. Finite is different than scarce. Right? Scarcity, by definition, implies illiquidity. It means you can't find it. Right? A piece of artwork is scarce because it can't be replicated. Right? It's hard to find a Picasso. Right? You can find Bitcoin. You're gonna have to pay a price for it, but you can find it in a second, right? So finite supply and scarcity are not one and the same. I always like to kind of counter that, and some people seem to think that's nuance and semantics, but I'm a big believer that definitions matter, because if you don't know how to define your investment, you don't know how to weight it.
That's a great treatise on Bitcoin. Thank you so much, Michael. So one question, I think this is about the last couple of questions, really. This is about India, right? So if I were to sort of go into the risk on, risk off kind of a story, risk off means assets that are weighted against, as you said, inflation and volatility. That essentially means dollar, gold, and treasuries, right? That also seems to mean, or implies, at least historically, that it means away from emerging markets. It means away from countries like India, right? Would that be a fair assessment to make? Does that mean when you're in risk on, there is more of a growth likely to be in emerging markets? I mean, because obviously, is that the way it plays out? What is the take on India here?
Yeah, so I mean, it's partially nuanced too, right? Because there's also a currency component. So for the most part, maybe less so with India, but for the most part, when the dollar is strong, emerging economies in terms of the local markets tend to not do as well, and risk off tends to also coincide with a strong dollar. So I'm making the argument that the risk off sort of co-movement permeates also because of currency interactions during those momentary periods where things get a little out of whack or get violent on the downside. Now, look, we know that the consumer sentiment is bombed out in India, obviously because of the tremendous surge in cases in COVID, and I deal with a lot of people in India. I'm doing an app myself and working with developers, so I'm at least kind of on the periphery aware of sort of what's going on the ground. India has, I think, a tremendous leg up compared to a lot of other economies, because India has, I think, largely been work from home for a long time, right? I mean, it's just, there's much more comfort, I think, in India than probably even the US in terms of being used to what that means to work from home. And that has other advantages longer term. In terms of the risk on, risk off dynamic, again, if you have a risk off period in the US, you better believe the Nifty is also going to break down. And interestingly enough, because of co-movements across sectors, what's been driving equity markets the last 3 months? It's been technology as a sector. Right? Initially, it was financials, it was energy, it was materials, it was the so-called value style. Then growth suddenly came back. I'm fairly certain that a good chunk of the India equity market is technology. So if you get a risk-off period, which means liquidity is drying up, you better believe U.S. technology gets hit, which is going to permeate into technology companies overseas because of the law of one price and co-movements that happen there. So excuse me. So I think I believe very much in India as a longer-term secular play. I actually think very much so that the U.S. is probably towards the end of its secular leadership in terms of asset markets, meaning that you've had such a dominating appearance of outperformance of U.S. markets that emerging markets across the board probably are the better longer-term asset allocation trade of a portion of an investment portfolio. Which all that means is that on any major decline, you probably allocate more towards India, more towards China, more towards other countries, as opposed to overweighting U.S. But again, if you get risk off in the U.S., you're going to get it everywhere. India will take a hit just like everybody else.
Got it. You just mentioned China. So I think the most recent news we had of China was really the loophole closure of Chinese companies listing in America. Do you have any thoughts on, what that means? Obviously, it has led to a sell-off in Chinese tech stocks at this point in time. But what are you seeing there? What is the longer-term implication of that story?
Well, this is why it's always tricky also just from an international investing standpoint, because as much as I'm saying there's a longer-term investment case for India or for China, again, I go back to the long term is hard to predict, and the hard thing that's really challenging with that is policy actions, right? Which can come in and because of any number of reasons between now and the future, make it suddenly hard for that investment thesis to actually play out because of these variables that come in out of nowhere from the political side. So I wouldn't be surprised to see more of that type of action. And it's interesting, right? Because we're in a it seems like this year, maybe I'm wrong. It seems like there's been more of these cyber attacks happening, right? More of these ransomware attacks happening from all over the place. And I think that's probably going to mean there's even more scrutiny around international investment availability for local investors. So I wouldn't be surprised again to see more of that type of action. Again, all that means is just weight it appropriately, because if that's a risk that you can't really account for, you have to take on less of a position.
Great. So thank you, Michael. I think that's I think there was one interesting reveal that we wanted to make today. And I think that was about the new initiative that you're doing. You're a foodie and you got some interest in food also. Why don't you sort of take the stage and, let us know what you're up to?
Yeah, no, so I appreciate that. So as is often the case, an idea tends to morph from the original idea into something bigger. So I used to travel all the time, and in my travels, I found it very hard to eat healthy, because a lot of studies show that if you don't have a kitchen, you tend to eat very poorly, right? Because the temptation is very high. And when you're traveling, the average weight gain is like 1.5 pounds per week. So I came up with an app I called How You Dish back in 2017, worked with developers that was designed to try to connect people to food that was healthy nearby. But again, as is always the case in any VC situation, in any entrepreneurial venture, you pivot. So pivoted a number of times. I'm now relaunching that app. So basically, How You Dish, when it's live in September, is going to be available everywhere, including India. It's an app that will allow users to connect to each other through the mutual love of food. For me, the interesting thing about that is that nobody's really done that, from what I can tell. You have all these apps that are dating and business, but nothing really around food, which is often how people tend to meet in the first introduction. And there's also kind of interesting dynamics as it relates to large data with that, right? Because if you can, based on geolocation, know food preferences, you probably, as a restaurant, would want to know that information. As a government, you may want to know that information to try to nudge a society towards a healthier way of eating in certain localities. So, it's been a 4-year process of trying to see what's the right way of executing on this. I think finally I have that in place, but come September, that's going to be live. If anybody's interested in just in checking that out, I'm happy to engage. I'm not trying to raise money for it, at least not yet, but stay tuned. That's a risk on play for my life.
I was just going to say, it sounds like an early stage play, and we would love to, if you'd love to have our money, we would love to back you in a second, right? So obviously, best of luck with that, Michael. And thank you so much. I think we learned so much about risk and, portfolio asset allocation. How do you look at things? What are the emerging, indicators? How do you watch yourself? To kill it, don't get killed. I think that's, the tagline of the day. So thank you so much. Really appreciate the time, and, stay safe and have a great day ahead.
Thank you, I appreciate it.
Cheers. Bye-bye.
Cheers.